Hi, welcome to this video today, which is on the habits of successful Forex traders. Now, in terms of this video, we're going to look at 10 habits. They're all easy to learn and apply. And if you do learn and apply them on a consistent basis, you'll keep your emotions out of your trading. You'll trade with better confidence, better focus, and total discipline. Now, I've written them up on a storyboard. So let's go and take a look at the habits in more detail. All right, let's have a look at 10 habits of successful Forex traders. Now, in terms of point number one, I've stressed this quite frequently in videos in the past. Successful traders do not have a high work rate. They have a low work rate, which sounds counterintuitive. Yeah, we're taught that if we work hard at something, we'll get more out of whatever we're doing. You work too hard in Forex, you'll get less out, okay? Now, what I mean by this is that you will see on YouTube, for example, a lot of so-called traders. They've got banks of computer screens. They're watching them all the time. They're trading in and out, doing market orders, responding to the price action as it unfolds. That is not a good way to trade because your emotions are immediately involved, okay? And it becomes very stressful. Okay, really, most of the time in Forex, not much is going on. You know, if you're trading in front of a price screen, trading in there, you're trading too short term, you're trading low odds trades, and you're making emotional trades as well. You know, your professional traders do pending orders through big levels. They let the market, take them in and take them out, and they don't watch price action much at all. Okay, sitting at a computer screen for hours on end each day trying to make money from the markets is a total waste of time. And if you think about it, think of great traders like Ray Dalio and George Soros. Do you think they sit in front of computer screens all day? No. So you don't need to work hard. You should do pending orders and don't watch price action too much. From my point of view, I'd watch it maybe 3 or 4 times a day, and that's it. Okay. Now, in terms of not working hard, that comes into play when you're doing chart analysis as well. There's no successful trader who looks at a chart and doesn't instantly know what to do with it. Okay, they keep it simple and quick. Few seconds, they know if there's a trade there or not, and they can move on to the next chart. I put the concept of blink. If you're unfamiliar with Blink, it is actually a book. It's by Malcolm Gladwell. You can look it up on Amazon. He makes the point that the quick decisions that we make are often the best, and that is the case in Forex trading. If you have to pore over a chart and look at it from several minutes or longer, your strategy is too complicated. You're overanalyzing the chart, and you'll probably come up with a low probability trade because you're looking for a trade, and a lot of traders are looking for trades all the time. They find it hard not to trade. Professional traders, they keep it simple, quick. They know what to do straight away or not. Okay, great traders, successful traders, they all have patience. Okay, they only trade really high odds setups. Okay, and also they have no fear of missing out. And you very often see a big move in the markets, a massive trend, and many traders are tempted to get in on that trend, despite the fact it's all over the media, and the media is saying it's going to go on forever. When that happens, the risk reward isn't there, and it's probably going to reverse. They have no fear of missing out. There'll always be another trading opportunity that will come up for them. Okay, they're long-term goal orientated. They focus on process over outcome. Follow their strategy religiously. They're not interested in week to week, month to month fluctuations. They're interested in how they perform over the longer term. And too many traders try to smooth their equity curve and want to make money every week, every month, etc. Simply is not possible. So successful traders know it's a long-term game, and most traders who come in the markets see it as a short-term game. Now, in terms of stop loss strategy. Successful traders put a lot of thought into their stop losses. Beginners tend to focus on the entry. They think the entry is more important. The entry for me is pretty easy. It's the stop loss that is the challenging part of the trade, because you've got to have it give you good protection, but you don't want to be bumped out of trades too soon. Okay, it's a fine balance. So you've got to pay as much attention to your stop loss as your entry. And you should do daily checks as well on your stops and also your exposure. Now, all traders just put trades on. They put an entry, a stop, and a target, and that's it. They leave it. That's not a great way to trade. You want to be reviewing your stop each day. Okay, move it if necessary, and you always need to be aware of exposure in the market. And you can ask a lot of traders, what actually is your exposure? If everything goes wrong, they cannot tell you. That is ridiculous. Okay, you never want to fall too far behind. You want to monitor your exposure daily. Okay, now in terms of point number 5, the habit of constant variant perception of the markets. Now, the concept of variant perception, or the phrase, comes from a guy called Stiegelmeier, one of the most successful managers of money ever. And he was saying, whenever you look at the Forex markets, you've got to be very contrary, and you've got to have a different perception. Okay, so you've got to be contrary to the majority. You'll never win if you follow the majority view. And in terms of this, when traders are looking at the market, they tend to fall in to the herd to a degree. Professional traders don't. They have a different perception of the markets. They don't want comfortable trades. Trades that are comfortable with the majority, they see one and looks a little bit too comfortable. They're immediately weary of what could go wrong with it. Okay, so you have to have a deeply contrary view of the markets. Point number 6, successful traders have strong opinions, but they're weakly held. Okay, you've got to have a strong opinion to make a trade. A lot of people say, oh, you shouldn't have strong opinions. You need to, but you need to be able to drop it, okay, if market conditions dictate. Okay, now put all successful traders are Bayesian thinkers. Now, they're Bayesian thinkers even if they're not familiar with Bayes' rule. Now, Bayes' rule is a way of basically stopping you from holding an opinion too long. What traders tend to do is, if they have an opinion on a trade, okay, they don't want to drop it. They will fall for what's called confirmation bias, where they'll look for supporting evidence of why their trade should go right, but they don't look at the counter argument of why their trade can go wrong. If you go and look up Bayes' rule, I've done videos on it. It's a great way of basically helping you drop an opinion if necessary. Okay, we all want to be right, but once you've got an opinion, it is harder to drop it than to keep it. Okay, that's a psychological fact. So you need strong opinions, weakly held, and you need to think like a Bayesian. Point number 7, they're proactive and dynamic in terms of trade management. I've already mentioned this a little bit in terms of stop losses earlier on, but in terms of being dynamic, also this comes into play. Let's say you've got a trade in the market. You put it on, you might be losing money. You think it's probably going to make money longer term, but you then see a better opportunity elsewhere. Successful traders will drop that trade even if it might be in a loss, and they think it's eventually going to come good, and go for the better setup. And that applies also if a trade is in profit. Okay, it looks like it might continue, but there's a better opportunity elsewhere. They'll shift to that opportunity. Pro traders are very focused on volatility and movement. When a market becomes dead and chops around, you're not going to make any money. You're looking for volatility in the markets, big moves, You want to have your money working as hard as possible. Now, in terms of point number 8, doctors, airline pilots use CLs. So what are CLs? They're checklists. So do profitable traders. Yeah, Warren Buffett, Charlie Munger, two of the most successful money managers ever use checklists. You should too. And I have a checklist for lots of different things I do in Forex, like a checklist for my kind of Bayesian sheet. I have checklists of rules that have to be adhered to in terms of trade setups. And the advantage of writing something down means, let's say you've got a checklist of rules and then you want to break them, then you know you're an idiot, don't you? Basically, yeah, if you have checklists, it reinforces discipline. Okay, it's like if you write a trading plan down, it reinforces discipline. For some reason, it's been psychologically proven. If you write things down, you use checklists, you will be more disciplined. Okay, so yeah, checklists really good way to keep you focused and disciplined. Now, point number 9, they're always learning. Warren Buffett's key lesson, it could be Charlie Munger's big lesson, and most of the top traders, Paul Tudor Jones, etc. They're all heavy readers. They want to learn. And a lot of people think, you come in the Forex markets, you learn a strategy, that's it. You don't need to do any more, you just apply the strategy. Markets are always changing. You've got to keep your psychology right. Reading is a great way to do it, and it's cheap as well. Okay, I will read at least a book a week. And in terms of reading, if you just get one little tip from a book, that can make you a lot of money. I think it's a great way of keeping you motivated as well. Okay, and inspired. So reading, you should be an avid reader, in my view. Point number 10, they maintain mental stability from inner conviction. Really successful traders, they don't get too down when they're losing money, and they don't get too excited when they're making money. That's because they have the inner conviction that they're going to make money longer term, because when they've developed their strategy, they've researched exactly why it works, what its trading edge is, and why it will lead them to long-term success. They'll also know, the downside of their strategy as well. There's no perfect strategy. All strategies have strengths and weaknesses. So be aware of the strengths of their strategy, also its weaknesses, and they will basically be able to trade, without those highs and lows emotionally. The big high when you make a lot of money, the low when you're in a period of drawdown. And I think a lot of traders, when they get down, they feel low, the confidence goes, their trading just suffers terribly. Okay, of course, a lot of traders, when they're winning, they think they're invincible, but that leads to kind of overconfidence, and then they give all the money back and more a lot of the time. So it's a mental stability thing from inner conviction. It's ingrained in them not to get too excited when they're winning and not too down when they're losing. So there you go. 10 very, very simple habits. If you ingrain them in your psychology, they will help you make consistent profits in the markets. So that is the video for today. Thank you very much for watching me as usual. Take care. Have a good day.